Hello friends, let's talk about the capital cushion or the capital buffer maintained by most of the well-performing banks. Banks have access to broadly two sources of funds just like any other business. There is owner's equity in business or what is called share capital and reserves, and then there are borrowings or funds supplied by the other sources. The owner's equity is represented in the form of tier 1 and tier 2 capital in a bank, which is share capital and reserves and surplus, share premium and such other long-term sources of finance. Whereas the bank's borrowings are typically in the format of the current accounts, the savings account, the term deposits, certificate of deposits, the borrowings from other financial institutions and any kind of borrowings from the Reserve Bank of India. Now, the capital of the bank is what is important when we want to assess the ability of the bank to undertake the level of risk. The bank that has larger capital base will obviously be able to undertake large amount of risk. They will be undertake lending to bigger projects and a big ticket item will be on their balance sheet. Whereas the relatively smaller banks with small capital will be able to undertake only small level of exposures. Apart from this, the risk undertaken by the bank is also driven by some other factors. For example, the lending against a collateral is relatively lower risky as compared to lending without a collateral. Also, other things being equal, if you are lending to an enterprise set up by the founders or the owners who have a long track record of running successful businesses, in that case you are carrying a less amount of risk. If you are lending to some of the business people who are new to business world and you even have, let's say, collateral, but still you may be undertaking higher level of risk. The banks maintain higher level of capital than what is mandated by the regulators, and this excess capital typically maintained by the bank is called the capital cushion or the capital buffer. Why do the banks maintain this additional level of capital? The additional capital that the banks maintain builds a certain trust in the mind of the depositors as well as in the minds of the counterparty banks. They know that the bank has higher equity base than what is required, so they can safely deal with that particular bank. Likewise, that capital is available for the bank for future growth because there are capital adequacy norms. If you don't have enough capital, you cannot grow your business. We also talk about the liquidity buffer maintained by the banks. The liquidity buffer is the additional amount of cash which the bank keeps over and above the normal requirement as forecasted by them in order to meet any kind of contingencies like sudden demand from the depositors or sudden withdrawal spree on the bank.